Okay, let's get this webinar started. Thank you for your attendance. Today we are going to do a What's Up with the Market session, and we're going to have a look at the indices again and some commodities as well, and just have a look at the overall market status. As you know, it hasn't been all that good. Before we do that, everything we cover here today is of a general investment advice nature. There's no specific or personal advice that is provided here, and past performance is not a reliable indicator of future performance. That said, let's change over into my instance of Beyond Charts and get into the analysis. Right, first up, as we always do, we don't look at the CRB, we look at the Dow Jones. And the Dow Jones is, let's just go back to what we spoke about a couple of weeks ago. And I left the analysis on the charts, is we had these symmetrical triangles forming, and which are the magenta lines, and coming to the apex, as you heard me say, and there was going to be a resolution one way or the other, either up or down. And this instance, it's been down. So there's been a sharp breakdown below the lower symmetrical triangle trend line. And we've fallen to, as I've been saying for a number of weeks, when we were basically declining down to this 23.6% Fibonacci, is that if it did fall below these support zones, is we might see a fall all the way down to 38.2. What's that 38.2? It's from the low, the trough that formed a year ago in October last year. So we basically had this 10-month run up. And sure, it didn't go straight up. It was a bit better on the S&P, as you'll see in a moment. There was more sideways movement and less growth. How do I know that? Looking at the relative strength line at the bottom over here, that's a relative strength comparison, not an RSI. This is a ratio between the Dow Jones and the S&P 500. So you can see the blue line declining means the Dow Jones was underperforming the S&P 500. Flattened out here, so similar performance, even though they're both in decline, so declining at the same rate. That's what it's telling us. But the Dow underperformed a lot in that period of time. So sharp breakout down to, excuse me, so the Dow sitting right on the 38.2% retracement of this run-up that was about 10 months long. So moving down to the S&P 500, the same period of time, going back to the trough back in October of last year, there's the symmetrical triangle, and the breakout has occurred to the downside, slightly above the 38.2% retracement. And this bottom chart I've got over here is the volatility. It's a 21-day ATRVE, basically using average true range as the volatility measure of the price action of the S&P 500. And you can see volatility starting to rise over here, being in decline. So typically you see falling volatility in a rising market and rising volatility in a falling market, and approaching that 38.2. So right on the lower channel line of this upward channel, that really is, if I go all the way back, I've got, what I do is I try and keep the same gradients of the channel lines that we have in a rising channel and in a falling channel. So that goes all the way back to 2020. They're the channel lines, and this is the lower channel line. So fallen, rise up, and now we are right on this bottom channel line. And we're also approaching a support zone where the blue rectangle is. So quite a few support zones merging over here. This is key. I don't mind the 38.2% retracement. That's pretty normal for bull markets. And 23.6 is actually an indication of strength, really good strength. 38.2 is still strength. As you know, markets don't go up in straight lines. And this is where the indices do need to find some support. So sure, we were in the September-October timeframe, typically a very negative, timeframe period in the market. And we into the first week of October, another 3 weeks to play out here. So this is really testing times. Are we going to have a big fall and not have the Christmas rally? Or are we actually going to find support here and rise? So we may have, in my view, we are getting pretty close to the bottoms, and we just got to get through this October timeframe. Let's see how the indices in the market handle that, and if support comes in, how will that happen? If buyers start buying at these levels, if If the perception is that these periods are oversold for what's going on in the macroeconomic and the microeconomic scene, then we might see some support come in, but not going to predict. Let's just go with the price action. Some other concerns here going to breadth of market indicators. This is the cumulative new high, new low. It measures the number of 52-week new highs compared to 52-week new lows. And you can see it's pretty difficult to see the gray line over there, but I've already put a trend line on, and it's starting to decline, meaning in line with the market falling over here. So there are more new 52-week lows. 52 weeks is obviously a whole year. So it's quite a broad, if you like. It's not a short-term indicator. It's more medium to longer term. And when you start seeing more 52-week lows being made than highs, that is definitely a breadth of market sentiment indicator saying there's weakness in the market. And the same is happening with the cumulative advanced decline line. It's basically just looking at all stocks and seeing how many are advancing versus how many are declining. And we certainly have more declining on the New York Stock Exchange than rising. Again, another breadth of market indicator showing weakness. And these will continue to do that. They won't preempt a rise. So we're not going to see these start rising before the market. Price action will lead every time. This is another breadth of market indicator showing weakness. Only 32% of stocks are above their 150-day moving average. So more stocks are below their 150-day moving average. That's divided by 21 to get that. It's what, 7.5 months worth of moving average there. So it's another medium to longer term breadth of market showing weakness as we would expect. The next sentiment indicator that we've been looking at is the consumer discretionary versus consumer staple. And what I do, so this here is a ratio, the second graph here, a ratio between the two. You can see it's slightly rising to flattening. If you go over the last couple of weeks or so, it's flattening. But what it's showing, even though consumer discretionary is declining, is that it's declining at a slower rate than consumer staple. And that is why what I use over here is I use the smooth Ciroc. It's a 55-34, and it's a trend following indicator, and it's saying that discretionary is still outperforming staples. Sorry, might have called it non-discretionary. Discretionary is outperforming staples, and that is still a positive sentiment relative to the overall market, but price action still reigns, and we can see consumer discretionary is falling, as will consumer staples, but consumer discretionary is falling at a lower rate. So that one is a bit confusing for people I might know, but that's a slight positive, not a negative. This is the one that I've been talking about for the last 3 or 4 of these sessions, which is the biggest concern, is the rising US dollar. So US dollar down the bottom over here, and that is the actual market, the blue line falling. And there is definitely an inverse correlation here. When US dollar rises, stocks tend to have weakness. So the US dollar is probably the one sentiment indicator that we have to, as I've been saying, keep an eye on over here. If this gets stronger, it's going to be tough for stocks to rally from there. So just a sideways movement in the dollar, some weakness. So the other 6 currencies, this is a basket of indicators against 6 currencies. If they start getting stronger against the US dollar, then that's going to be positive for stocks. How would that happen? It would happen if there is money that moves into other markets. So how would this happen? Is that US investors in the US stock market would go and see better value in other equities markets or in other commodities that other markets are more well known for, and that would take money out of US dollars into those currencies, which would see weakness in the US dollar. And then, of course, the whole cycle goes where the US markets get to a point where they stop falling, and then the whole cycle repeats again. So this is a major sentiment indicator to keep our eye on, is the US dollar. I've introduced another sentiment indicator that I look at from time to time, and this is the dots that you see up in the top graph over here is volume. It's volume of the puts versus the call options on the S&P 500 stock. So there's an equities put call ratio, they call it. and it looks at the volume. So really what it's trying to do is measure how much volume is going into puts and how much volume is going into calls, on the basis that the smart money will, if the market's going to rise, if they see it's going to rise, or they feel it's oversold, then they would go, they would buy calls. If they feel the market's going to fall, they would buy puts. And so it measures this, and it's really what we do here. This is looking at going back to what, 1998, so 25 years, and you can see all the dots over there, the volume. And what I've done is put an annual 252-day smooth moving average, and just to try and get some of that noise out of there. So it's an annual smoothing of the volume. And then I've put my favorite trend following indicator on here, which is a CIROC, and I've got a 26.9 on there because we're trying to measure, you know, about six months worth of this. So so what we it's a little bit, sorry, about 3 months of it, and won't go into that now, but it's really half a cycle. And the way what I look at here is when the CIROC falls. You can see I've got a green arrow over here, sorry, a green vertical line, and that green vertical line is when this falls. It's basically saying that it's time that more calls are being bought than puts, and therefore it's time that there are more people that are buying, that are positive, that are bullish about the market. And when this CIROC indicator rises, it's saying that there are more people negative, because there are more puts, there's more volume going into buying puts than what there is into buying calls. And it's actually got quite a good correlation to the bottom chart over here, which is the S&P 500. It's not like all sentiment indicators, it's not spot on perfect, and it shouldn't be used on its own. But when you bring it in to use with other sentiment indicators, you start getting, you know, a weighting, if you like, of positive versus negative. And so when you look at this, you look at the US dollar, you look at some of the breadth of market indicators, the advanced decline line, and the new 52-week highs versus lows, and definitely it's showing a bit of negativity. When did this signal? When did the puts start outperforming the buying of calls? Well, in the middle of August. So a couple of those lined up there, then we could see that this had been soon after the market has started falling. Now, this can get whippy, and it can get a bit whipsawy, and so it doesn't always line up, but it's confirming what is happening in the market at the moment, and it does lag a bit as well. So it's not really that leading an indicator. Sometimes it leads. This time it looks like it did a pretty good job, but certainly on buying the S&P 500, it is pretty late to the party, 22nd of May, when really, you know, we were buying back over here in October last year. So there it was a little bit late to the party in terms of giving a positive sentiment in terms of calls. So it's so another one to add to the quiver of looking at from a sentiment perspective. The VIX is you'd expect it, volatility to rise with the markets falling, and just made a new high over here in the short term over the last 4 to 5 months. And of course that will rise if price falls. Okay, now the second major US index is the NASDAQ Composite Index, and it is right on the lower channel line. We'll just zoom in here a bit. And it's right on this lower channel line as it has been for the last 4 or 5 trading days, similar to the S&P 500. So again, slightly above the 38.2 Fibonacci retracement, and we do want an above this support zone over here. So it could go, and if the market does get a bit more negative, you'd expect the NASDAQ to retrace a bit more than the S&P 500. Why? Because during the period of the market rising, you can see this ratio over here, this relative strength comparison to the S&P 500 is showing that the NASDAQ was stronger than the S&P 500. So you'd expect a bit more of a retracement. You can see now there has been weakness, which means it's retraced more already than in relative terms to the S&P 500, but relative to itself, it's roughly the same retracement as the S&P 500. And what I'm looking at over here, this is a CIROC at the bottom over here of this relative strength line, and it's still saying relative to the overall market, the NASDAQ compared to the S&P 500, it's still a hold. So a little bit of positivity there, but telling us exactly what's going on at the moment. Right, cumulative new high, new low on the NASDAQ. And as everybody's been talking about for some months now, is that You know, there's half a dozen to 7 odd stocks. I call them Magnificent Seven. And it's the Nvidia, Amazon, Google, and Microsoft, Apple. They're the ones that have pushed this market up, and there hasn't been a really wide. Mid caps and small caps haven't really joined the party, and you can go and look at those indices to show and prove that. And what this cumulative advanced new high, new low line over here is showing is just that, is that whilst the NASDAQ has risen, the new high, the 52-week new high, has actually declined, and that has that's shown a divergence. There was a bit of rising over here, so they were in tune, and now they are, and now they're in tune again back to the downside. So they were in tune to the upside there, and now in tune to the downside. And there was divergence over here, which is an indication of potential weakness coming, which eventually came. So we do need the broader market to come and join the party here. On the NASDAQ 100, there are just under half of the stocks are above their 150-day moving average. And again, that's a sign of some weakness. And this is the NASDAQ 100 index at the below over here, so telling us what we know. Right, another sentiment indicator is the semiconductor index relative to the NASDAQ. And we can see that there's just a bit of weakness coming in over here where the CIROC, and this is quite a medium-term one, a 55.34, medium to longer-term one. And it just started declining here. It hasn't dropped below the 90 level over here, which is really the exit signal, if you like, on this sentiment indicator. There is weakness over there, and there is a bit of relative weakness to, this is a relative strength line compared to the NASDAQ composite. So a bit more weakness in the semiconductor sector, industry sector, compared to the overall NASDAQ composite. So this is a bit of a leading sentiment indicator looking at this. So this would tend to show more weakness and more strength. And so that's why we had during this last run up from the trough in October last year, you can see that the Philadelphia semiconductor industry sector outperformed the NASDAQ over here. That's what we're looking for on the upside. So that's a bullish sign. So this one is showing a little bit of weakness, but not quite there yet. Right, just going on to yields, 10-year yields, Treasury notes, strengthening here. So yields are starting to go up by more. And the relative strength line, this is showing that here is around about, what is that, the middle of August is the time that this indicator, if you like, sentiment indicator, gave a buy signal on the 10-year Treasury relative to the S&P 500. And you can see that the divergence has happened there, 10-year yields rising, equities falling. So the bond to equity ratio, if you like, is showing that it's now a time of weakness in stocks, which we know. So this compared to, now you've heard me say that the US dollar to stocks ratio has a far higher correlation than unsurprisingly, because everybody talks about it, than interest rates to stocks, bonds to stocks, or bond yields to stocks. And so this one I don't put as much credence in, but at the moment, with inflation, the big talk, it's certainly got a bigger sway than if you go back and look at historically, as I've done over here, as to how high the correlation is. So sometimes you can get both going in the same direction, both up and both down. At the moment, there is that negative correlation, and that's because inflation is very much in the news at the moment. So what will happen in the short term? Well, we do need yields to stop going up or weaken or go sideways to see stocks turn around. Will that happen in the short term? I don't know. And as you know, I don't get into predictions. Right, last couple of indices to look at is the All Ordinaries Index in Australia, fallen to support here. And really the weakness you can see relative to the US markets, some strength early coming out of the trough of last year, but during calendar year 2023, the All Ordinaries has massively underperformed the US markets, and that's this blue line declining over here, showing me that a bit of flattening at the moment, and that's really because they're both declining at roughly the same rate. So where does this need to find support? Right where it is. You can see this is quite a strong support resistance line. and it really does need to. There's resistance, support, 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 broke through a little bit in resistance, support, 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 and it does need to find support here, or else it could go lower. And that's the same with the other indices as well. So really, they're all getting to pretty much support zones that need to hold. If they don't hold, well, then we're going to go lower, and we'll see a whole lot of sell signals in our mechanical portfolios. So just a word quickly on the mechanical portfolios. Most of them have gone into cash. Certainly the SPA3 trader only has one open position and has for some time. So that's been in cash for some time. The SPA3 investor portfolios are not fully invested at the moment. They're somewhere between, I think, around about 60 to 75% invested, with more sell signals coming today on the Australian market. So what we don't want to do is get this market to push us to the lengths where we are 100% in cash, and then it turns around. Obviously, if we go 100% into cash and it keeps falling, that's great. But we don't want to miss a bounce and a continuation of the uptrend here. So what are we going to do? Well, we don't have to make any decisions. If you're mechanical, is that you just continue to follow the signals. And what we want those signals to do is, if the market does bounce, to keep us in the market to some degree. And if it does fall later, to really to fall further, then ready to take those exit signals and go into cash, because the next support levels are quite a long way down from where they currently are. So really right on the edge here in terms of where this market goes from. Will buyers come in and buy this support and provide that support to the US markets and the Australian market, and for that matter, a whole bunch of other markets around the world, or will actually the sellers get in control and we go further? And that's going to be decided, in my view, in the next 2 or 3 weeks. And I'll be back before the end of October to talk about that some more. Just looking at the share price of Australia, the Australian dollar v the US dollar, more weakness over here. Where is this relative to the past? Well, that's the last 25 years. It's only really had, one little bit over there, but really 2 periods below the support level where it is at the moment. So share price of Australia not doing that well at the moment. That's also on the back of the strength of the US dollar as well against the other currencies around the world. So another negative for our market. Last index to look at is the Nikkei, which has been one of the stronger markets even since the end of last year. This is going back to December 2022, when the S&P 500 was rising, so was the Nikkei. And how do I know that? It is rising by more than the S&P 500. This bottom chart, this relative strength chart, is showing that it's outperformed. It's rising against the S&P 500 on a support level, a relatively new support level over here. And look, interesting to see if that holds at this level as well. It's just gone below the 23.6 on the last session in the Japanese market, and it's time for me to put a 38.2 in here, which we'll quickly do now. And so you can see how that's done. Simple as that. And that is the next level of support that we would like the Nikkei to hold. Quickly, let's just go through commodities. So before that, quick summary, which I've already done in basis, is the next 2 or 3 weeks are vital to see where the support comes in and the buyers come into the market, this market at these support levels, these support zones that you've seen, or whether it capitulates and falls below that, in which case there'll be tons more exit signals, as there have been on the Australian market today, yesterday for today, then if that's the case, there'll be more sell signals if there's capitulation below these support levels. Quickly onto commodities. I'll go through these pretty quickly. That's the CRB index. It's some strength and got up to support levels, broke out of this downward channel, underperformed stocks on the way down, now outperforming stocks. That's the commodities stocks ratio, if you want to call it that. Gold, there's been some weakness. I'll just zoom in a bit over here. There's that all-time high up there, the black support resistance zone, the black resistance zone. And it's now just fallen through support. I've just redrawn a bit of outperformance here against equities, underperformance in equities. I've redrawn this light gray channel over here, and just to take in these tops, these peaks, and it has fallen pretty quickly below this support zone and moving down to the next one. If it gets back into this channel over here, the black one, then that's going to not bode well for gold. and silver is following it down. Relative strength is much the same, so going down at the same rate. Copper, there's still no weakness. It hasn't there's still no strength. It hasn't broken out above this declining channel over here and really going sideways at the moment. So weakness there as well. And oil is in a narrow rising channel. That's really what's driven the CRB index, and has fallen quite sharply. And so you would have seen oil stocks fall as well, and probably will in the Australian market today, and weakness there as well. And the next one to look at is the Bitcoin. A bit of a breakout in Bitcoin over here. One of the indicators that I know that one of our customers found and uses to trade Bitcoin and some of the other or Ethereum are the only two that we have price on, is a bit of a buy signal over here. That's the green line using a Ciroc 26.9 is what I've manually back tested, if you like. We haven't run any simulations with it, but it seems to work quite well. And a buy over there, some strength, break out of this channel, come down, one bar of retesting the upper channel line. Let's see if that holds, and then bounces from there. But both Ethereum and that's Ethereum and Bitcoin are showing some positive signs. Right, uranium was where the talk of the town is. That's rising against stocks, and bounced off this lower channel line, and now time to take this upper channel line and draw it up to there to get it, but there's some resistance above, and that is uranium is strong, and there are some uranium stocks that people I know are trading at the moment. The iron ore has had a breakout out of this downward channel, risen, come down, retested, and is looks like it's making a new peak. We need to see this breakthrough resistance as well. So keep an eye on iron ore for iron ore stocks. And the same with thermal coal, breakout above this trend line and rising. Let's see where that next peak actually forms. Okay, so that's where I wanted to leave it. I think you've got the summary. What I will do, I'm going to do a session. Dave and I are going to look at doing some sessions about, because this really is a market where there's pockets that are doing okay. And it's like the uranium at the moment is like the honeypot that all the bees are going to, and the honeypots change from time to time to different parts of the market. And so we're going to look at doing a couple of those where we look at just pockets of the market and do some analysis using those, and give some hints and tips, if you like, on how you might do that, because we know a lot of our clients do take little bits of money as part of a satellite strategy, and they go, and what are the words that people use? Go and have a flutter here or there, or a dabble, or a bit of speculation. So we'll do that to add a bit of interest while this market's going down and sideways with our larger amounts of capital. I do that from time to time. I'm not doing it at the moment because I'm working at other stuff, but no harm in actually having a webinar like that. So if you're keen to see some of that happen, then please let us know either now in the chat, or send us emails, or have a chat on the forum about it. Okay, any questions that anybody would like to ask? Thanks, Jermaine, for that tip about trying WebEx. I think that's a Cisco product, if they haven't sold it. But if there's no questions coming in, we'll get this up on YouTube, and you'll be able to ask questions there. And also yes, please, from Emily about doing the pockets of the market webinars. Okay, good, John. Thanks for that, people. Okay, we'll end it there. If there are no questions, thank you for your attendance, and I'll do another one of these in a couple of weeks' time. But just keep an eye on those, and you can all get access to the analysis. We'll have the analysis up for you to import into your instance of Beyond Charts, and just keep an eye on those support zones in the major indices. Until then, until next time, I wish you consistent and objective investing.